Genesis Strategic Consulting. I'm here to demonstrate a tool that I've created for real estate investors. Now, whether you're a veteran, a newbie, or a soon-to-be investor, this tool is for you. Now, I've spent hours upon hours researching multiple websites and online tools that could give me a quick analysis of a potential real estate deal. Now, if you haven't already gone down that same rabbit hole, I'll save you the time. Most of the web search results or what I call capture pages that basically want to capture your email and your contact information so they can send you a bunch of emails about buying their secret insider only software or their masterclass that will take you from $50,000 a year to making over $400 or $1 million a month or whatever the case may be. You've seen it. Now, if you're like me, you don't want the fluff. You simply want to put in a few numbers and you want to know if it's a good deal or not. So let me show you what I've created, and if the tool adds value to the investor life, to your investor life, then great. So as you can see, there are 5 tabs here. I'll go through all the tabs in this tutorial. However, 99% of what you want is in one tab, the Deal Analyzer tab. Now, this Instructors tab provides the basic contact info, the owner of the digital content, the purpose of the content, and then a few assumptions, like you must have some of the data. You must know what the house is going to be worth once you're done repairing it, the bank's interest rate, the amortization loan, or the length of what the bank is going to base the payment off of, the down payment requirements that the bank has, what you expect to receive in rent, your vacancy rate expectations, and then your LTV of what you want. We'll go into that a little bit more. So the Deal Analyzer tab is really the meat and potatoes of the whole workbook, which we'll go into more in depth in a few seconds. So the Tips tab basically just gives you some of the industry lingo, a few definitions. So if you see the ARV, what it means, after repaired value, that's something you can go through. And then next is going to be the amortization tab. Simply put, it's a breakdown of the principal and interest payment over the term of the loan. It'll give you the total interest that's paid out, the total payments that you pay back over the term at a certain interest rate based off of a certain loan amount. And then, of course, last but not least, is the disclaimer. It just goes over kind of, we give general information for informational purposes only. We don't have any liability or accept it for any loss or damage of any kind incurred as a result of our site or the information that we provide. So let's get back to the meat and potatoes. So the Deal Analyzer, it's really simple to use. It's got 3 easy steps here. So first, what you want to do is you want to update your bank fields. These bank fields, you're going to just simply plug in the bank information and the names that you choose. So for example, for bank 1, let's say if our bank's name is Great Bank of Louisville. And bank 2, let's call it Bank of Jeffco. And bank 3, let's call it My Credit Union. So once we do that and we update the bank names, next we're going to enter the percent of the required down payment for the purchase. And if the lender only funds a portion of the rehab, then we're going to enter that as well. So as you see, the Great Bank of Louisville, it's so great because they only require 15% down, which means they fund 85% of the purchase. They do 100% of the rehab, so that's 0% that we have to put down. Then the Bank of Jeffco, they do kind of a standard lending of 80%, which means we have to put 20% down of the purchase, and they fund 80% of the rehab. So we have to have 20% of the rehab as well for that loan. Now, My Credit Union, they have a required down payment of 20%, so they fund 80% of the deal, and they will do 100% of the rehab. What we have next is the interest rate, kind of self-explanatory. The Great Bank of Louisville is 6.5%. The Bank of Jeffco is 6%. The same with My Credit Union. Now, here's a little bit of difference here. So the amortization term is basically that's the amount of years that the bank will base the payment off of. So many banks, they may do a 5-year term, which means that the loan has to be paid off at the end of 5 years, but your payment will be based on a 30-year period or a 25-year period, or in the case of My Credit Union, a 20-year period. Now, second, we have our max offer field that you see here. The max offer field is going to put in where some of the information you're going to need from the assumptions. That's going to be the ARV, which is the after repair value. In this case, the house is going to be worth $130,000. A good way to come up with that value is simply to go out and look at like properties, square footage wise, bedroom wise, bathroom, within the same area that's closed within the past, I would say, 3 to 4 months. Now, target LTV. LTV is loan to value. That simply means what type of equity do you want to have based off of the value of the house and how much debt you want to take on. And so a lot of investors, they want to be max 75% loan to value. So the loan amount versus the value of the property. The rehab budget is also another number that you need to know. That's how much money you're going to put into the house to rehab that house and to complete that project to make it back like new. Once you put those figures in, automatically you get a calculation of your max offer for your target LTV of 75%. That means on this deal, you can't offer any more than $47,500. And the next field here is going to be your actual offer. So what exactly are you offering? What are you going to be under contract for on that particular property? In this example, it's $40,000, which gives us a total investment of $90,000, which is our $50,000 rehab, and our actual offer of $40,000. Last, we're going to enter our estimated rent amount. As you see, everything that you have to put in is highlighted. And so you see there's only 4 pieces of information for each bank, 4 pieces of information for the max offer, and 1 piece of information for the bank and for your calculations. Now, in this sample, we're using $1,300. And $1,300 is the estimated rent for this 3-bedroom, 2-bath property that we're looking at. So after you put this in, that's where the magic happens. You simply select the lender from the drop down, and all the calculations run behind the scenes. So you click here, here's the drop down. Now, as you notice, we have all of our banks that we named over here in the drop down. Last, we've got some hard coded information here for hard money. This is an estimate of what hard money would be, which is typically less favorable terms than you would find with a bank or a credit union. So if we go to the Great Bank of Louisville, we take a look at this, you'll see where the down payment is 15%. The interest rate is 6.5%. The term is over 30 years, and it breaks down the principal and interest payment, and if it's an interest only payment. So back up to the top here. At $1,300 per month rent, the potential annual rent is $15,600. Now, of course, we have to account for vacancy due to tenant turnover, repairs, etc. So here we use roughly 8% or a month per year. So that leaves us with $14,300 in operating income. Next, you will find the operating expenses. Operating expenses are going to be items like your management fees, your maintenance, your property tax, your insurance. In this example, it's $3,995. That leaves us an NOI, or a net operating income, of $10,305 annual. So that leaves us with a cap rate of 8%. The cap rate, in simple terms, basically just means what type of yield this property produces over a year. You take the net operating income, you divide that by the value of the asset, and that's how you get this percentage of what the cap rate is. The last section of the analyzer provides an important ratio that many commercial lenders include in their underwriting process: the DSCR, or the debt service coverage ratio, which is simply just another way to see if the operating income would pay the debt of this asset. So a DSCR of 0.98 simply means that the property can only pay 98% of the debt, while a DSR of 1.5 means that property can pay for its debt 1.5 times over. Many lenders require a DSR of 1.2. As you see in this case, a principal interest payment of $530.94 leaves us with a DSCR of 1.62, which a lender would love that. Now, if you like this deal analyzer tool, please share it, like it, comment on this video. The tool is available for purchase for $30 as is, or for a more robust or customized template, such as if you want to add more lenders, you want to add your property tax to it, your insurance, or for us to just do all the legwork for you and turn over a completed template to you. Email us at contactus@genesisconsultingky.com. Always remember, the money is made when you buy, not when you sell, and just start wherever you are. Thank you for your time.